Usually when we look at financial markets, there is this comforting expectation of cause and effect. Sort of supposed to feel a bit like physics, you know?
Right, like gravity.
Exactly. Like when macroeconomic data gets undeniably bad, the charts break down and gravity just takes over. You see that heavy red line on your screen? The analysts all point to the structural failures, and everyone just agrees that a drop is, well, the logical consequence of the environment.
Yeah, I mean, it's how we expect the system to function. We really want our market corrections to be visible and to follow these established rational rules. When support gives way, things should fall.
But then you step into the reality of what we've actually been living through over the last 5 months, and suddenly those rules seem, they seem completely suspended.
Oh, absolutely. It's been wild.
We are looking at a market landscape right now that has been an absolute masterclass in psychological torture. For you, for me, for everyone. The entire market has just been grinding sideways, slowly bleeding out everyone's conviction.
Just brutal, week after week.
Right. And every technical indicator was flashing red. They were screaming that a massive structural breakdown was imminent. Every trader you talked to was just sitting there hoarding cash, waiting for the floor to fall out. And then in the span of a single week, the entire dynamic flipped.
Yeah, it was a textbook structural fakeout. And honestly, from a behavioral finance perspective, that is actually one of the most explosive forces in the market.
Well, that is exactly what we are unpacking today. We are looking at a scenario that every investor completely dreads living through, but secretly dreams of catching at the very bottom.
The holy grail trade.
Exactly. So we're doing a deep dive into a newly released, highly detailed document. It's the Market Situation Report. Trend Update, authored by Miad Kasravi and Pheneck, dated April 13th, 2026.
A really fascinating piece of research.
It is. Our goal today is to figure out exactly why a seemingly exhausted bearish market just ignited into what this report claims is, like the very beginning of a massive multi-month bull run. We're going to decode the specific algorithmic patterns they've identified, patterns pointing to some huge setups in major tech and in crypto, too.
And doing that really requires looking past the day-to-day noise. To understand the mechanics of what just happened, we have to synthesize a few very different worlds here.
Right.
We need to look at how geopolitical calendars, the raw math of AI automation margins, and the hidden mechanics of market liquidity are all colliding right at this exact moment.
Okay, let's unpack this. Let's start with the macro picture, because the physical mechanics of how this breakdown turned into a launch pad are just fascinating.
Yeah, they really are.
According to the report, the NASDAQ had suffered a 13% drawdown and then spent 150 days, 5 solid months, just trapped in sideways compression.
A total grind.
Right. And the authors point out that these inside 3-week candle patterns were actively breaking downward. But let's pause right there, because inside candle is pure trader jargon. What is that actually showing us about human behavior?
Good question. So, think of an inside candle as a visual representation of a standoff.
Okay.
It means that the entire price movement for a given 3-week period was completely contained within the high and the low of the previous 3 weeks.
So nobody is making any real ground.
Exactly. The buyers aren't willing to push it higher, but the sellers can't drag it lower. It's a compression of volatility. And as these compressions drag on for months, traders get impatient, They start placing bets on which way the standoff will ultimately resolve.
So when that standoff finally started breaking downward, the bears thought they had won.
They thought they nailed it, yeah.
But then a headline hits about a Middle East ceasefire, and the market suddenly rallies 10% off the lows, specifically that 22,834 lows. But the report argues the headline itself is basically irrelevant to what happened next.
Right, completely irrelevant. The headline was just the match. The fuel was already piled up.
How so?
Well, when that downward break happened, short sellers piled in, betting the market was going to crash. But when the price sharply reversed on the news, all of those short sellers were suddenly trapped.
Oh, wow.
Yeah, they are forced to buy back their positions to stop their losses. And that forced buying pushes the price up, which triggers even more panic buying from other shorts. It's a mechanical short squeeze.
Right, so it's not investors enthusiastically buying the news, it's traders running for the exits.
Exactly. And the authors stress that the structural repositioning that followed is permanent.
What do you mean by permanent?
Normally, when a market is in a bear phase and it breaks through a support floor, that old floor becomes a new ceiling, right?
Yeah, standard resistance.
But the NASDAQ completely ignored that rule. It vaulted straight back up through those broken support levels with absolute authority. It created what institutional traders call a confirmed bullish order block.
Okay, and another piece of jargon. A bullish order block. What does that actually look like in practice for, a regular trader?
It's essentially a footprint left by massive institutional money. Retail traders like you and me don't have the capital to reverse a 5-month trend in a single week.
Fair point.
When the price slams down into a specific zone and immediately rockets back up, it tells you that a major institution, or, well, probably several of them, had massive buy orders sitting there defending that level. They literally built a wall.
It makes me think of holding a beach ball underwater.
Oh, that's a good analogy.
Right. Like for 5 months, the market was just pushing this ball deeper and deeper. You had people betting it would reach the bottom of the pool. But the moment the treasure slipped, that trapped energy forced the ball to rocket straight up out of the water.
Yeah, and the deeper you push it, the more violent the snapback.
Exactly.
And that snapback is really the core thesis of the Kasravi and Pheneck report. They actually used Claude AI to run algorithmic backtesting on the NASDAQ's entire trading history, looking for this specific sequence of trapped energy.
Right, and they found a permutation called an inside 3-week cluster breakout.
Yes.
And this is the part of the report that made me do a double take. This specific combination of factors has only happened 13 times in the entire history of the index.
Just 13 times.
And the historical win rate on those 13 instances is 100%.
100%. It's crazy.
Every single time, it has delivered a minimum 15% forward return, and the trending move lasts at least 15 weeks. The last time this setup fired was in October 2023, and that yielded a 30% return over 6 months.
It's a super rare signal because it requires a very specific extreme in market psychology. You need peak fear, followed by a sudden, undeniable invalidation of that fear.
So if everyone was sitting on their hands, waiting for volatility to spike so they could buy distressed assets at a discount, did the market just structurally front-run the entire bear thesis?
Basically, yes. The institutions built their wall before the retail crowd could even react.
Wow.
That's the reality of institutional positioning. And the strategy note from the authors here is highly specific. Once this pattern confirms, you don't just buy and close your eyes.
Right, you need a plan.
Yeah, you use the previous 3-week period's lowest price as a rolling stop loss, trailing it upward to capture the trend while protecting your downside.
Okay, so the technical footprints are telling us the market is a coiled spring. But charts don't operate in a vacuum. A chart can tell you the market is ready to move, but it doesn't give you the spark.
Right, you need a catalyst.
Exactly. What is the real-world catalyst making this happen right now?
Oh.
The report points a massive finger at the 2026 calendar.
The geopolitical clock. It's a totally underappreciated force, but it acts as a massive structural tailwind for market liquidity.
Let's look at this timeline because it is incredibly stacked. June 2026, the FIFA World Cup is being hosted across the U.S., Canada, and Mexico.
Huge event.
Then July 4th, 2026, the United States 250th anniversary. Semi-quincentennial, if we want to get fancy.
I can barely pronounce that.
I practiced.
Yeah.
And then November 2026, the U.S. midterm elections.
Right. And the authors argue that this sequence creates a profound systemic incentive to stabilize the markets.
How so?
Well, if the government or the central bank needs to absorb any economic disruptions or let the air out of any bubbles, the timeline dictates they do it early in the year, like April or May.
Before everyone's paying attention.
Exactly, because the goal is to engineer the recovery so it peaks. Just as the nation is celebrating its 250th birthday, global tourists are arriving for the World Cup, and most importantly, voters are getting ready to head to the polls.
Now, I want to pause here just to frame this properly for you listening. When we talk about this, we are strictly analyzing the historical math of political incentives.
Right, no politics here.
Regardless of who is in office or what political party holds power, the incumbent playbook is generally the same. We are not taking sides. We are just looking at what the source material observes regarding historical market behavior around major national events.
It's purely about the mechanics of incumbency. Administrations historically avoid implementing policy shocks or draining market liquidity heading into midterm elections.
Makes sense.
The incentive overwhelmingly favors engineering a risk-on environment by the summer.
I do have to push back a bit, though.
Sure.
It's one thing to read a stock chart and talk about trapped short sellers. But can we really assume that an entire global multi-trillion-dollar market will bend its trajectory just because there's a soccer tournament and a national birthday party on the calendar? It feels a little like the tail wagging the dog.
If we connect this to the bigger picture, it's not that the market consciously cares about a soccer tournament, right? It's about the fiscal and monetary levers pulled behind the scenes.
Okay, the liquidity plumbing.
Yeah. During these highly visible national windows, the threshold for government intervention completely changes. They are way more likely to smooth over banking issues, inject liquidity, or pause aggressive rate hikes.
So they just grease the wheels.
Exactly. The market isn't reacting to the World Cup. It's reacting to the accommodative macroeconomic environment that the World Cup incentivizes politicians to create.
That makes a lot of sense, actually. So now that the macro stage and the political calendar are set, we need to know who the primary actors are in this bull run. And the report points directly at Amazon as the single best vehicle for this entire thesis.
Technically and fundamentally, Amazon is the anchor of this report's strategy.
Let's start with the technicals. The report notes that Amazon is forming a massive one-year ascending triangle on the 3-week time frame. Let's translate that for everyone. What does an ascending triangle tell us about the buyers and sellers?
An ascending triangle is this beautiful visualization of shifting power.
I like that.
Imagine a flat, horizontal ceiling, a price that sellers aggressively defend every time the stock reaches it. But underneath that ceiling, the buyers are getting increasingly impatient.
So they keep stepping in earlier.
Right. Every time the stock dips, they buy it back sooner and sooner, creating a rising floor. It's like a vice slowly squeezing upward. Eventually, the buyers are pushing so hard that the sellers run out of shares to dump, the ceiling shatters, and the price explodes upward. Amazon has been building that exact pressure cooker for an entire year.
Here's where it gets really interesting, though. The fundamental story behind that pressure is what caught my attention. Amazon is pivoting incredibly hard to autonomous robotic fulfillment.
This is huge.
Right. They are actively replacing human labor in their warehouses with 247 AI-driven robots. The report calculates that this shift could effectively double Amazon's profit margins.
Double margins. That is the holy grail for a mature tech company. While other tech giants are still trying to figure out how to monetize their AI chatbots, Amazon is executing physical AI integration in real time across its massive logistics network.
The real-world application.
Exactly. The infrastructure is already built. Replacing human labor with robotics is a pure efficiency gain that drops straight to the bottom line.
It's like looking back at Amazon's first decade. They were famously unprofitable because they were spending billions building the world's most complex, expensive highway system.
Yeah, and Wall Street thought they were crazy.
Exactly.
Right.
But now, the highway is built, the warehouses are everywhere. They are just replacing the expensive human truck drivers and warehouse workers with self-driving machines. Instantly, the whole system turns wildly profitable.
The margin expansion is just massive. The report compares this setup to Google. When Google integrated its Gemini AI, it drove a 100% rally, practically doubling the stock price from a multi-trillion-dollar baseline.
Which is insane to think about.
Right, and Amazon is sitting at a very similar market cap right now, around $2.5 trillion. Even a proportional move, like a 50% move, adds $1.25 trillion in market cap.
And the report lays out a very specific options play to capitalize on this.
Yeah.
But the mechanics of how they suggest trading it are what's interesting.
They aren't buying weeklies, that's for sure.
No, they aren't suggesting short-term weekly options. They're looking at LEEA calls, long-term options, specifically targeting expirations all the way out in March 2027. They're looking at the $285 to $290 strikes, currently trading around $19 a contract.
Right.
They are targeting massive returns, 100 to 150%, with the stock moving toward a 330 to 350 final target. But they specifically note you need that long expiration because breakouts from year-long compressions take 4 to 5 months to fully unfold.
And this is where amateur traders get wiped out, you know?
How do you mean?
You can look at an ascending triangle, correctly predict that the ceiling's going to break, and still lose all your money if you buy options that expire next month.
Oh, because the timing is off.
Exactly.
Mhm.
Big structural macro moves take time to play out. You are buying time so that you don't get shaken out by short-term volatility while the larger thesis actually proves itself.
But Amazon isn't acting alone here. The broader tech sector is showing some really specific catch-up and liquidity patterns. The report introduces a strict primary filter for buying tech stocks right now. Does the stock have a 2-week bullish engulfing pattern?
A very strict filter.
Yeah, if yes, it's a buy. If no, you avoid it entirely. They specifically say to avoid names like Microsoft, Oracle, and Tesla because they fail this test. So, what is a bullish engulfing pattern, and why is it the ultimate gatekeeper for this strategy?
A bullish engulfing pattern is a visual representation of total capitulation by the sellers.
Okay.
It happens when you have a week of downward price action, and then the very next week the price opens lower but immediately surges so high that it completely swallows or engulfs the entire previous week's trading range.
So it just erases the previous week.
Yes, it tells you that the momentum didn't just slow down, it violently reversed direction. If a stock isn't showing that specific aggressive reversal right now, the authors are saying it lacks the institutional backing to lead the next rally.
Which brings us to Meta. The report calls Meta the best risk-reward catch-up trade on the board. It bottomed at the exact same time as Amazon. It perfectly mirrored Amazon's initial rally. But right now, it's lagging behind. It is a 17% upside gap just to reach parity with where Amazon is currently sitting.
It's essentially a form of structural arbitrage.
So if Meta and Amazon are doing the exact same dance, but Meta's a few steps behind, is that essentially a cheat code for investors to see into the future of Meta's chart?
In a highly correlated tech market, yeah. If two mega-cap stocks are driven by the exact same macroeconomic wins, structural lag is just an opportunity. You are literally just buying the delayed reaction.
Then we have NVIDIA, which offers a completely different but equally powerful setup. NVIDIA is printing what they call a double inside 2-month candle pattern.
A mouthful.
Very much so. But the critical detail the report highlights is that NVIDIA skipped its upside liquidity sweep. Explain the mechanics of a liquidity sweep to us, because it sounds like we're talking about plumbing, not finance.
Well, it is the plumbing of the market.
Fair enough.
Think of a liquidity pool as a cluster of resting orders. There are thousands of dormant buy and sell triggers sitting just above or below the current price, things like stop losses or automatic buy orders.
Just waiting to be hit.
Right. Often, before a stock makes a massive move downward, it will briefly shoot up, sweeping that upside liquidity. It triggers all those waiting sell orders, exhausting the buyers, and then it drops.
So it's like intentionally triggering a bunch of tripwires to clear the path.
Precisely. But NVIDIA didn't do that. It skipped the upside sweep entirely and only swept the downside.
Interesting.
Yeah, that means there's a massive, untapped reservoir of resting buy-side orders waiting just above the current price.
So once it starts moving?
Once NVIDIA starts moving up and hits those tripwires, it's going to trigger an automatic wave of buying, creating a vacuum that rapidly pulls the price higher. Their target on that is $211.
Wow. And rounding out the tech side, they look at Broadcom ticker AVGO. It's been consolidating for over 5 months, forming a macro higher low. It layered a bullish order block right on top of old support, and there was a huge open gap sitting above it.
A classic setup.
What does a macro higher low tell us about the psychology of the people buying Broadcom?
A higher low simply means that during a pullback, the buyers refused to wait for the price to drop all the way back to its previous bottom. They stepped in early.
They were eager.
Very eager. When you see that happening on a macro scale over 5 months, and it's layered on top of that institutional footprint we talked about earlier, it shows that big money is quietly accumulating shares. They're building a fortress of support before the next leg up.
So if tech is building a fortress, what is happening in the crypto space? The deep dive shifts gears here, noting that the NASDAQ's bullish structure is perfectly mirrored in Bitcoin. But there is a massive AI discovery layered on top of it.
Yeah, the crypto analysis in this report is fascinating because it relies on finding mechanical rules in a market driven almost entirely by sentiment.
And the sentiment is terrible.
Oh, it's abysmal.
Crypto has been in a brutal bear cycle since early February. The report describes it as pure sentiment capitulation, like absolute zero engagement on social media. Even the loudest, most obnoxious Bitcoin maximalists have gone completely silent, just total agonizing boredom.
Which, historically, is the truest sign of a market bottom.
Really?
Yeah, markets rarely top out when everyone is bored, and they rarely bottom out when everyone is panicked. They bottom when people just stop caring.
So what does this all mean? Everyone is hyping up AI as this hyperlogical, emotionless force. But the authors used Claude AI to run backtests on Bitcoin, and the AI is basically telling us that the most human emotion of all total boredom and sentiment capitulation is the ultimate buy signal for Bitcoin.
It's a great paradox, isn't it? But the AI also found a mathematical rule that human traders had just completely missed.
What's the rule?
Claude uncovered a structural property in Bitcoin's history. Inside daily candle lows act as dynamic support levels indefinitely. Yeah. This raises an important question about how we trade. The report notes that Bitcoin exhibits secular drift. Because it has a finite hard cap supply and is fundamentally a long-only asset, the AI backtesting shows that the absolute best strategy is one that uses no time stop.
No time stop. That goes against everything you're taught.
Exactly. This is a huge behavioral shift for traders.
Right.
Most people fail because they anchor their trades to a specific time window. They buy a volatile asset and say, if it doesn't break out in 2 weeks, I'm selling.
Guilty as charged.
Right, we all do it. But the AI simulation proved that applying traditional time constraints to an asset with absolute scarcity is a losing game. You have to remove the time constraint and let secular drift do the work. The math favors infinite patience.
The specific setup they outlined based on this AI model relies on an incredibly firm support floor at $66,500.
Right.
They outline an entry around $71,296 with a non-negotiable hard stop just below $64,900. And the targets are huge. Target 1 is $93,681 and target 2 is pushing into all-time highs above $109K.
It's a massive move.
That represents a 77% return to all-time highs. And because the AI-verified floor is so historically reliable, the report actually suggests utilizing 3x to 4x leverage to amplify the move.
It's an asymmetrical risk-to-reward ratio. You know exactly where your thesis is proven wrong, just below that established support floor, but the upside is driven by the entire historical weight of secular drift.
And if you don't want to trade Bitcoin directly, the report covers crypto-adjacent equities. They are very clear, though. Avoid altcoins, avoid Ethereum. Stick strictly to Bitcoin-first derivatives.
Keep it simple.
Yeah, they highlight a company called Hyperliquid, ticker PURR, trading around $6 a share. It's disrupting the actual architecture of how markets function.
Hyperliquid is fascinating because it bridges the gap between decentralized finance and traditional Wall Street.
They allow users around the world to trade traditional stock equities using stablecoins.
Democratizing the whole thing.
It totally democratizes the market for a global audience who might be completely locked out of opening a traditional brokerage account. The stock just posted a massive 37% weekly move, and it's their top equity pick for the crypto side of the portfolio.
It's a pure infrastructure play. They're taking the massive dormant liquidity of the crypto world and building a pipe that aims it directly at the traditional equities market.
We have covered an incredible amount of ground today. Let's just quickly summarize the critical takeaways from the Kasravi and Pheneck report.
Sounds good.
Number one, we're looking at a 100% historical win rate macro pattern triggering on the NASDAQ right now, driven by trapped short sellers. Number two, Amazon is sitting on a massive technical compression, fundamentally fueled by an AI robotics margin explosion.
Right.
Number three, we have perfectly timed geopolitical catalysts acting as a tailwind into the summer. And finally, an AI-verified sentiment bottom and structural support level for Bitcoin.
The most important synthesis of all these points, though, is the timing.
Why is that?
I want everyone listening to remember that the window for positioning ahead of these structural shifts is incredibly narrow right now.
Like how narrow?
Measured in weeks, not months. The fake-out has already happened. The institutions have built their order blocks. The train is leaving the station.
It brings us right back to where we started. We expect markets to be clean and rational. Instead, they get messy, they grind sideways, they trick everyone into betting on the breakdown. But when the fog finally clears, the patterns that emerge are undeniable.
Absolutely.
I want to leave you with a final thought to chew on today. We just spent this entire deep dive talking about how the authors used AI to backtest decade-long stock cluster patterns and uncover infinite support zones for Bitcoin.
Right.
And at the exact same time, companies like Amazon are using AI to physically replace their human workforce to double their margins. As you watch these charts over the next few months, ask yourself, are we approaching a point where AI isn't just analyzing the economy for us, but is actually becoming the economy itself?
It's the ultimate convergence. The tool is becoming the system.
Something to really think about. Thanks for joining us on this deep dive. We'll see you next time.